Today, I'm taking a balanced look at entrepreneurship, not just the excitement of building something of my own, but also the costs, demands, and trade-offs that come with that choice. We'll consider what entrepreneurs may need to invest, including time, effort, and uncertainty, alongside the potential benefits of creating and leading a business. The goal is to understand entrepreneurship realistically, so the opportunities and challenges can be evaluated together rather than viewed in isolation. This discussion is part of business plan development. Entrepreneurship is often described as starting a business, but the idea is broader than that. It begins with recognizing an opportunity, then deciding whether to invest your time, resources, and energy to pursue it. That decision involves both financial and personal risk, along the challenge of organizing what's needed to turn an idea into something real. At its core, entrepreneurship is a choice with trade-offs. Understanding those trade-offs helps create a more realistic foundation for planning, evaluating opportunities, and building a sustainable new venture. Entrepreneurship appeals to millions because it offers the possibility of meaningful rewards across several dimensions. Financially, it can create opportunities to build value and benefit from the success of an idea. Professionally, it may provide greater autonomy, ownership, and the chance to shape work around personal strengths. Personally, it can bring a strong sense of purpose and accomplishment. The case for entrepreneurship is not only about making money. It is also about creating a path that feels more independent, intentional, and personally rewarding. Entrepreneurship offers benefits that extend well beyond simply owning a business. Financial upside is one important advantage. When a venture succeeds, profits belong to the owner, and earning potential is not limited to a fixed salary. There's also autonomy. Entrepreneurs shape the vision, make key decisions, and build a culture that reflects their priorities. At the same time, they can create products or services that address meaningful problems. Finally, running a business accelerates learning, strengthening leadership, financial, marketing, and negotiation skills across many different functions. This slide highlights three important financial benefits of business ownership. First, the owner receives a net profits rather than earning a fixed wage that stays the same regardless of company performance. Second, a successful business can become a valuable asset. It may be sold, franchised, or passed down, creating an opportunity to build wealth across generations. Finally, entrepreneurs may be able to deduct legitimate business expenses, such as equipment, a home office, or travel. Those deductions can reduce the overall tax burden when they meet applicable requirements. Entrepreneurship offers meaningful opportunities, but the path also demands sacrifice. The real costs are personal, financial, and professional. Personally, the journey can require sustained effort and difficult choices. Financially, it may involve uncertainty and limited resources. Professionally, entrepreneurs often accept risks that can affect their stability and future options. The important point is not to romanticize the process or ignore these trade-offs. Honest entrepreneurs recognize the cost before they begin, so they can approach the journey with clearer expectations and a more deliberate commitment. Entrepreneurship can be rewarding, but it also carries significant costs that deserve an honest look. The biggest is financial risk. Many founders invest their own savings, and failure can leave them with debt that takes years to repay. There's also a serious time sacrifice, with early-stage entrepreneurs often working 60 to 80 hours a week. Add the ongoing stress of unpredictable income, payroll, clients, and market changes. Finally, there's opportunity cost. Choosing a startup may mean giving up a stable salary, benefits, and advancement elsewhere. A thorough cost-benefit analysis gives me the full picture before I commit to a business decision. It means looking honestly at both the potential value and the resources, risks, and trade-offs involved. The goal is not to eliminate costs, but to plan for them realistically. When founders understand both sides, they can make better decisions, set more achievable expectations, and respond more effectively when challenges arise. The strongest entrepreneurs do not ignore difficult realities. They anticipate them, prepare for them, and build their plans with adversity in mind. This slide offers a realistic view of business survival. 1 in 5 new businesses fails during its first year. Nearly half have closed by year 5, and two-thirds do not reach the 10-year mark. The most commonly cited challenge by year 5 is cash flow. These numbers are not intended to discourage entrepreneurship. They show why preparation matters. A strong business plan helps address the risks behind failure, including undercapitalization, inadequate market research, and weak operational planning, before those problems become harder to solve. A strong business plan helps turn uncertainty into a set of challenges we can understand and manage. Market research shows us who the customers are and what they actually need. Financial projections help estimate costs, revenue, and the resources required to move forward. Risk analysis highlights potential obstacles before they become expensive surprises. And strategic planning connects these insights to clear priorities and actions. Together, these elements transform abstract entrepreneurial risk into measurable decisions, helping us allocate resources more wisely and improve the odds of building a sustainable business. The key takeaway is that entrepreneurship is a calculated trade-off. Significant rewards are possible, but only when I honestly account for personal capital, opportunity cost, and uncertain income. A strong business plan is my risk management tool, helping address likely causes of failure before they occur.